Just check my microphone here. Sorry. All right, it looks like we're live. Good morning, everyone, or afternoon, wherever you are in the world. See, there's a few questions already. Good to see. Just give people a few minutes to roll in here. Usually takes a couple of minutes. So about that, again, just a reminder that I will always give notification on Twitter, right? That's probably the best place. I send these out on LinkedIn, Facebook, Twitter, to my private community, but I'll always give more of a heads up on Twitter. So probably the best place to get notified. It just makes it easy. You can just bump your thread, and I don't like to start a bunch of new threads for these every time I'm trying to remind people. So just give me a quick follow on Twitter. My Twitter handle is there @VolatilityVix, and you will be notified. So, and of course for other things as well, like this week we had the reverse split in the VXX, and I had a lot of people telling me that they weren't prepared for it. They didn't know it was coming, and a lot of people very angry at their brokers. I did remind people. I did give heads up. I did videos. I did a live stream. So if you ever want to be reminded of certain things in the volatility space, I'll probably catch most of them and give people a little bit of heads up. So might want to give me a follow, and might give you a little better preparation, because I did notice there's quite a few people who are upset about how the whole thing was handled. There will be a live Q&A after this. I'll talk about the ARK fund in a second, and then later on we'll just open it up to questions. Ask me anything you want. Trading, investing, volatility, options, or unrelated business stuff, whatever. Ask me about golf. But there will be an open Q&A later, and I would imagine there'll be a couple questions on the VXX. So yeah, just give me a follow on Twitter. And while I'm letting people roll in here, I don't use my live streams as some marketing campaign. So I typically don't even bring up what the VTS community, but just allow me 1 minute of little housekeeping, just to introduce myself for people who are new here. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, well, thanks everybody for coming this morning, and probably interested in that topic, the ARKK Innovation ETF. I don't talk about it much. This is actually the first time I've mentioned it in a video. I haven't done really anything on it, but one of the reasons that I do these live streams, they're fairly new for us. We started I guess in November or something. So pretty new, but it gives me an opportunity to answer questions with a little bit more detail. So I get tons of emails, and as you'll see as I go over some of these numbers for the ARK fund, more so recently, and you'll see why that is. But I get a lot of people asking, well, should we use this ARK ETF as a substitution for some of our other positions in our strategies? And of course, I will answer those emails and I'll give people the answer that applies to their question. But I do like to use the live streams. If enough people are asking the same question, then it is better to just go through it in detail. And this is something that I get asked all the time, increasingly so. So you guys can all listen in to the answer that I give. The basic reasoning for why at the very end of this, it's up to the individual. I want to make very clear that this is not any personalized investment advice. I'm not telling people to buy or sell or don't buy this, it's too risky. This is all just my personal opinion, and I'm just going to go over some numbers, some charts. So let's open up the first thing with checking out the performance of this ARKK Innovation ETF. So essentially what this thing is, you can definitely say that it's tech heavy. So it's an ETF that has active management, and they are essentially going out and selecting a basket of stocks that they consider to be innovative companies. Disruptors is what they would essentially call them. These are things like Tesla and Zoom and Zillow and all kinds of companies like that. Roku, things that they consider sort of disrupting the industry. A lot of potential for explosive growth. And this is what it looks like. So the fund launched on October 31st, 2014. So it's been around for about 6.5 years. And you can see the performance here. It's been very good if you just look at the absolute number. If you just look at, long-term, 33% return, that's very good. The drawdowns obviously very large, but these are, as we will get into, higher risk tech stocks, so you have to expect some significant drawdowns along the way. And to be honest, I'm not going to talk about it much today about my predictions, but I would imagine that it could get significantly worse than that. But yes, the absolute headline number is very, very impressive, 33% return. So the one thing that probably stands out to people, hopefully anyway, is that a good portion of this is recent. This is why I said the emails that I get about this fund has really ramped up over the last, say, 6 months or so. And this is why. You can see it clear as day. So this is slightly cherry picking. I understand this is cherry picking, but it's just to illustrate a point that if we divide this by pre-COVID and post-COVID, we can kind of see what's happening here. The first 5.5 years of the fund, it's not like it was doing poorly, but 13.87 annualized return is fine. And it's really this last year, I guess 14, 15 months, it's up 191%. So this is why that you have probably seen, you probably didn't even know this fund existed. 2-3 years ago, you'd probably never heard of it. And recently, it's obviously getting a lot of news. And this is why. It's up 191% in the last 15 months. Very, very impressive results. And of course, that will lead to the fund itself becoming more popular. It's in all news outlets. Everybody's talking about it. We can see here, there's several of them. ARK actually has many different funds. There's some new ones as well. But it's this yellow one we're looking at, the ARKK Innovation ETF. You could say that that's their flagship fund. And that one's in yellow. So we can see that when it launched, it really had no interest at all. And not really surprising. Why would it? It was basically underperforming the benchmark for a few years in the beginning. So not a whole lot of interest there. But then it starts to catch a little bit of attention, starts to do a little bit better. But it's really right here. I mean, we can see it clear as day. This is COVID right here. This is the March 2020. And since then, assets under management for this thing have gone from the low single digits, 2-3 billion for a couple of years, up to right now, I think it's about 22 billion under management. So basically 7 times the amount of assets under management in just the last year. This thing has absolutely exploded. But I think, and again, I'm not telling people not to buy it or to go out and buy it or how great this thing is. I'm just trying to give people perspective. So when I'm talking about things like this, I don't want people thinking, well, he's trying to steer us in a certain direction. I am really just essentially reporting the news. I'm not trying to overlay my personal opinions here. But having said that, if we compare it to the benchmark, which I think is a reasonable benchmark, the underlying NASDAQ, we can see that it, for the first 5.5 years of its life cycle, it essentially didn't outperform its benchmark. Now, on an absolute basis, it was still slightly higher at the COVID period over these 5.5 years. It was less than 1% higher, but it was slightly higher on an absolute level. But on a risk-adjusted level, it had underperformed its benchmark. You can see it started out pretty slow. It had an explosive 2017, very good year in 2017, but the variance is much higher. The drawdowns are higher. The inconsistency is there. So while it did technically on an absolute number slightly outperform the NASDAQ, on a risk-adjusted basis, I would say it significantly underperformed for the first 5.5 years. And then what happened? Well, clearly something has happened in the last year where it has just completely decoupled from the index, and now it's just skyrocketed. So some of you watching, I'm sure you know the answer by now, but in a word, Tesla. This is Tesla stock, right? I'm sure everybody knows what Tesla is. I don't have to go into it. But Tesla was chopping around doing next to nothing for 3 or 4 years before 2020. And then all of a sudden, for whatever reason, and it's a very hot button subject, so I'm not going to try to overlay any opinions about this. It's clearly gotten what most people could probably recognize as a little bit ahead of itself, but I'm not going to say it's the most overvalued or it's a great value. That would obviously trigger a lot of people in the comment section. We're just reporting the news here. As a matter of fact, this thing has exploded in stock price. Whatever you think the reason for that was, great, you can think that. But it went from the 20s, 30s, 50s up to over 700. And if we look at it as a number perspective compared to the underlying NASDAQ, you can see for several years it was doing worse. And then all of a sudden, in the last year and a half, 18 months, this thing's up 1,500%. So, Tesla growing like this, why does that matter? These are the top 10 holdings for the ARKK Innovation ETF. So why does Tesla's explosive growth matter? It's their largest holding. They hold 11% of the fund is Tesla. Now, of course, some of that, is if Tesla's stock price keeps rising, well, it will make up a larger percentage of underlying indexes and ETFs. That's normal to see. But I guess the point is, that's when rebalancing comes in. When something's up 1,500%, you could rebalance. They do have choices here. It's an actively managed fund. But the point is that Tesla, something that's up 1,500%, if it has a 10% allocation, clearly that's why we see things like this. Tesla just exploding higher. Obviously, that's going to be a huge benefit to this underlying ETF. And we can even look at some of these other names, right? Some of you will recognize these names. Square, Roku, Zillow. A lot of these are just crushing it the last year, the last 15 months since that COVID bottom. Whatever happened in that bottom, there were some of these companies that just benefited tremendously. You could say that maybe some of them are based on fundamentals, maybe some of them are based on just momentum of media coverage. Whatever it is, the fact remains that a lot of those companies that the ARKK Innovation ETF has selected have exploded in growth. So credit where credit is due. They have obviously chosen some good companies here. These are the top 5 holdings. So the NASDAQ is in turquoise. It is the lowest by a substantial amount. All 5 of their top 5 holdings are really, really doing well. You've got 200, 300, 400, and of course Tesla nearly 1,500%. So good for them. I think that's great. They've obviously selected some good companies. The thing that people have to remember is if you are not a holder of the ARKK Innovation ETF yet, and you're trying to get into it, the decision you have to make is how do you think it's going to perform starting today going forward? It's definitely important to look at track records, right? And this thing is not new. It's been around since late 2014. It's important to look at track records, but you also have to be realistic. Ideally, you would want to see a track record that is fairly consistent year to year. Sometimes it's a little bit risky jumping into these momentum things that if you look at a 6-year window, it is making a certain rate of return, but it's largely due to one single outlier year. That makes it more risky. I'm not saying it's too risky, but clearly that will increase the risk. You would rather see something that is consistent in several different types of markets. So that's the question people need to ask themselves. Is this thing starting today, going forward, is it likely to continue the performance it's seen in the last 1 year or the performance that it saw in the first 5.5 years of its life cycle when on a risk-adjusted basis, it underperformed its benchmark? I'm not here to tell anybody what the final answer is, but I do manage an investing community, and I have to make concrete decisions. So when people ask me this question, should we substitute the ARK fund for something else in our portfolios? What they're essentially getting at, and I know this is specific to VTS. Sorry. Let me mute that. This is specific to VTS, but it will also be meaningful to get to the point. So this is Friday's email that goes out every time. So essentially what my community does, we have 5 tactical rotation strategies. So nothing we do is buy and hold. I'm not a believer in buy and hold. I think the drawdowns are just insanely large when you are handcuffed into holding things long term. Performance is very, very low, as we've seen. So I'm a tactical investor. Strategies rotate between several different choices based on volatility metrics. And so we have equities here, S&P 400 mid-cap. We've got bonds and gold. This is a volatility ETF or volatility strategy. We've got same thing here, tactical rotation. One of them is equities. And then down here, we do have another one that actually holds the NASDAQ. So this is really where people are asking the question. Should we substitute the ARK fund right here? Now, clearly the answer for me is no, because I still use the QQQ. I could quite easily, starting on Monday, I could just let everybody know from now on, this ARK fund is what we're going to be believing in. That's going to be our quasi-equities position here. So we've got bonds when volatility is very low. We've got utilities when the market is going down. But for this equity portfolio within the defensive rotation, I could switch it out and I could go for that ARK ETF. But again, I have to ask myself the same question. I have to look at the data and analyze what's happening, and does it have a place in my portfolio? And for me, the answer is no. And there's main reasons for that being, like I touched on, a massive portion of this performance from that ARK fund is happening just in the last 15 months. And that in itself, for me, is a little bit of a red flag. I like to see performance consistent through different market environments. I would have liked to see the ARK ETF perform just as well coming out of the market crash in 2015 as it did coming out of the COVID in 2020. I'd like to see it have really good performance coming out of the Volpocalypse in 2018, the Q4 crash in 2018. It didn't. There's just something new in this market where these tech names have just caught fire. We can't deny the performance, but is it repeatable? That's the question. So for me personally, I have stuck to the QQQ within our defensive rotation strategy. I don't like the fact that I can't really predict how this thing is going to perform in different environments. As an example, this is our performance of that strategy. And of course, since COVID, we've also done very well. But focus on this last period for a second here. The markets are at all-time highs, so this is not a surprise, right? I'm not reporting anything and saying, wow, we're doing incredibly well, we're crushing it. We are, but the market is also at all-time highs, so this is fairly expected. The ARK fund, let me see if I can pull this up here. I didn't have it before. But let's go to the last 3 months of this fund, and you'll see what I'm talking about here about the consistency. So this is measuring against the Qs. The Qs in turquoise, all-time highs. Everything's fine. The ARK fund has gotten crushed in the last 3 months, even though the stock market is at all-time highs. If we remove the Qs here, this thing went from 156 down at the lows to 110. That's an over 40% drawdown while the markets are at all-time highs. Now, for me, as a long-term tactical investor, I need to know how the underlying assets I'm holding perform in different environments. It is one of the most important aspects for me to understand the correlations, to get a good idea of how what I'm holding is going to perform if X, Y, and Z in the market happens. With something like the ARK Innovation Fund, that is a hand-picked basket from a team of obviously very smart people, we don't know that that's the case. So right now, I like the fact that my portfolio is at all-time highs. It should be. The market is at all-time highs as well. Most of my work is focused on drawdown reduction. So of course I have plans, contingencies in place. If the market crashes, we will be able to profit from that as well. But the market's at all-time highs, and I need to know that my positions that are quasi-equity positions, they are also at least near all-time highs. I can't invest in something that at any moment, despite the market doing well, it could be down 40 or 50%. I simply can't. So for me personally, that is the answer that I've been sort of driving towards, is there's no way that I could use this fund, given its performance, despite the fact that the absolute number is good, how it got there is not consistent enough for someone like me to be using it in my strategies. So the last question I want to touch on is I want to offer a solution to what people could do if they're trying to get that explosive growth. Obviously, the reason that people would use this ARK Innovation ETF is because you look at the numbers and you also want to participate in something that is crushing the market. There is a solution for that, and I sort of pointed to it, but let me just show you exactly. This right here is a comparison of the ARK Innovation ETF to the 2 times NASDAQ, the QLD, right? There's QLD is a 2 times, there's the TQQQ, that's a 3 times. There are leveraged NASDAQ ETFs. There are leveraged S&P 500, S&P 400, there's leveraged Dow. There's all of these available to us. Look at the performance of the leveraged QLD compared to the ARK Innovation. Of course, those first several years, I probably should have shown a log scale now that I'm speaking out loud. But anyway, the gap here, this is actually a pretty significant gap. So the first 3 years, of course, the QLD was crushing it. And then right here, this is when the ARK Innovation ETF took over. But you can see the 40% drawdown right there. That's a massive decoupling. But there's nothing wrong with using the QLD if you're trying to boost performance. Because at least in this case, again, you're not dependent on a team of stock pickers to get you the performance of 2 times the market. You are only dependent on the market. So what would you rather invest in? Something, let me try to scale this. I don't know if you're even going to see it very well. Let me try to scale a side-by-side comparison of the top holdings of the NASDAQ compared to the top holdings of the ARK Innovation ETF. You can see the difference in these names, right? Of course, these are what they deem to be the disruptors. These over here, as far as the QQQ, these are the largest companies in the world. These are Apple, Microsoft, Amazon. Not that they're not explosive growth companies, they are, but they've already gone through those phases where they're not likely to see that 1,500% Tesla growth. The only reason Tesla's even here is because it grew 1,500%. This is a market cap weighted ETF. So of course, the bigger the company gets, the more weighting it has in the underlying index. That's why Tesla's here. But it wasn't before. It was far lower than that. But these companies, most of them, and certainly if we drop down another 20 or 30, most of them have already gone through that initial explosive phase, and they are more stable. I wouldn't say that Apple, Microsoft, Amazon, they could also drop substantial amounts pretty much at any moment, but it would be because the market is dropping, not independent of the market. These companies essentially are down, they had a drawdown of 40% while the markets were at all-time highs. Obviously, just by pure definition of an index, that can't happen if this is what you're holding. You are holding the market. So again, that's the question. Starting today going forward, what would you want to invest in? Would you want to have something that essentially tracks the market? If the market's at all-time highs, you can predictably use that ETF in your own strategies. Whether that is buy and hold, of course, that's not something I do, but it would be predictable. Markets are here, your portfolio looks like this. Markets go down, this is what you could expect to happen. Correlations hold up over time. You can measure things versus bonds and gold, and there's a long-term track record. You can't do any of that with the ARK Innovation ETF because it's entirely discretionary. It's based on holdings that, again, credit where credit is due. They have selected some pretty good companies the last year, better than I did. I don't go choosing individual stocks, so I'm not here to beat them down in that sense, but it's unpredictable. How can we possibly know the forward progress of where this thing is going to go? We can't. So, like I said, there is a solution, and I personally do use that solution. We also have a leveraged version of our defensive rotation strategy. Same strategy, same signals. We just find ways to use leverage whenever possible. And that's what I use within this. I use the QLD, 2 times NASDAQ, as whenever we're holding equities, that's what we will be in. This strategy also does hold bonds from time to time, utilities as well. But when we're in equities, I really do need to know how it's going to perform. That is the key. Starting today, going forward, I need to be able to actually analyze this. I need to be able to get all of the beta factors in my spreadsheets and make some realistic forward predictions. Everything is uncertain. Certainly possible the ARK just continues its meteoric rise, but I think people have to be realistic for the fact that, as the old saying goes, what goes up must come down. I'm not necessarily saying that's going to happen or that it's imminent, but please understand that we saw the same thing during the dot-com bust. The NASDAQ at that time dropped 78%. There were a lot of individual names that dropped a lot more than that. So you have to understand, something that goes up 1,500% in 1 year, it is a brilliant story. And anybody who participated, congratulations. But you have to understand that there's a very far distance between where it came from to where it is. That's not true for an index. The index is the index. So long story short, and this is why I like to do these live streams, to just be able to show all this data. It's much better than an email. Long story short, for all the people that are asking me, shouldn't we insert this super exciting ARK Innovation ETF into our tactical strategies? Wouldn't we be better off? No. In my opinion, no. I use the underlying NASDAQ as our unleveraged holding, and I use the 2 times leveraged ETF, QLD, for our leveraged holding. And for me, that's predictable. That I can actually analyze. I can quantify where it has been, where it's going to go, how it reacts to the market. So congratulations to everybody who held the ARK up 191% in the last 15 months. That's pretty impressive. But I will certainly be keeping an eye on it, and maybe I'll do another stream about it a year from now. Like I said, we all need to make decisions starting today going forward. This is one of the major problems in the investing world that a lot of people don't understand until it happens to them. But you look at something, say a hedge fund, for example, and they report a headline number. This hedge fund has made 30% a year for the last 6 years. But what you realize is the drawdowns might be insanely large, and that would mean that you would have exited that fund when you panic sold, right? That's what happens. We're all human. Emotions are involved in investing more than people realize. And if you panic sell, you're out, and then the fund recovers, and you're not there to participate. So that headline number that looks so amazing on paper, realistically, for real people to be tracking it year to year to year, it's not realistic at all. And the same thing you could say for this ARK fund. Just looking at it, just imagine you're an investor. Insert yourself into this page. You are an investor who held this thing from the beginning. For the first 3 years, you got nothing from it. It wildly underperformed what you thought it was going to do. Of course, you pulled the plug here, right? Right here, there's no assets under management. We know that. We can see the data. That right here, it didn't even register on the assets under management chart, remember? That's here. There's no money here. But then the thing starts to skyrocket. So what do people do? They chase shiny objects. They see something doing really well. And right here, people start to buy along the way up. And it had a tremendous year. And some people early on might have participated. But then it went through a very long period of chop where you wouldn't really have wanted to be holding it anymore because even the benchmark is doing better than this fund. So a lot of people would have been exiting and panic selling during these big drawdowns. But then it goes on an explosive run. Maybe it sucks people in here. So you buy again. And then what happens? You have a 44% drawdown and you pull the plug again. Then it shoots higher. You're not in it for this growth. But then eventually you look at it and you say, well, how can I not be? I have to join this thing again. So you join it somewhere on the uptrend, and then boom, a 40% drawdown hits you again. So a realistic investor, an actual person with emotions, would never have buy and hold this thing for 6.5 years. You wouldn't have been in it here. You would have missed this phase, or at least the first part of it, because only when it made the news would you have even known it existed. And then you would have probably sold either here, during a very choppy, extremely unstable flat period, and then a massive crash. You wouldn't have gotten this. You maybe jump in, maybe you get this, but then you're down again 40%. So it's not enough to look at the average long-term rate of return and just say, I want that number. Investing is far more difficult than that, and it's far more emotional. And I would submit that there aren't that many people who could have made rational decisions all along the way with this fund. And a lot of hedge funds are the same. You see them raising massive amounts of capital. While they're raising the capital is when the performance dwindles, right? The big numbers that suck people in are all the good times when nobody knew it existed. And then all of a sudden it hits the news, a whole bunch of people pour into it, and then you start noticing, wow, as a real investor with real money, I didn't get the number that hedge fund reported. I didn't see that in my actual account. That's why it happens, because how something gets to that number is more important than the number itself. The annualized return, sure, it's valuable to know that number, but how it got there, focus on that, and you'll make better decisions. So for me personally, I don't like how the ARK fund achieved its 33% return. How can a quant investor like myself look at that and honestly think I can somehow predict the future of how my strategies will perform? I can't. It's all over the map. I'm not saying it's bad. The number's obviously good. I can't. So for me personally, QQQs, QLD for leverage, and good luck to everybody who's holding it. I hope it continues well for you. But I'd be a little worried when I look at those top holdings. I think, boy, if the markets start to decline, I would bet good money that the ARK fund has a much larger drawdown than the broad market does. Not for sure. I'll certainly come back and update everybody, but that is my opinion, that the bottom could really drop out on something like that. Just like it did in the dot-com bust. There were many, many good, solid companies, individual names, that dropped well over 90% during that period. So it will potentially decouple again from the underlying index even more. But that's my assessment on that fund. Exciting, but no thanks. So now we'll just open up the Q&A. You can ask questions about the ARK fund, of course, or we can just ask about any old thing. We like to do these open Q&As for everybody who follows on Twitter. Again, follow me. Where's my little Twitter following? Follow me on Twitter. You can jump on and ask your questions. So let me go back to the very top here and see if we can catch up on a few of these. Looks like there was a 4-part one here. One thing I ask, I always hate to ask, but we do have to ask, just hit the like button for me. It really does help out on YouTube, where the ratio for likes compared to how long people watch it, they've got this complicated algorithm. Go ahead and hit the like button for me. It's totally free. Just hit that button. Doesn't cost you a thing. All right, so Igor is asking, I'm going to go through all 4 of these because it's a 4-part question. So I have to run out. One topic to get to here about the commentator. Interactive brokers totally botched the corporate action on VXX. Whole Friday, the new option series were not tradable, and the old options had major liquidity issues. In addition to the old series they called Basket VXX1, could be only closed and not traded in both directions, even when advantageous. I didn't try to make any trades, so I can't confirm or deny. Sorry, I'm not clicking these as I'm reading them. He was saying that on Friday you had liquidity issues, could not actually trade it. You had to close only. I probably should have done a few test trades just to see, because I can't confirm or deny that. Do we have elements for a potential class action? The first 3 parts of this question, I would say it's unfortunate. A, that you didn't really know that this was coming and weren't prepared for it ahead of time. Again, follow me on Twitter. I'm going to cover all of these things. UVXY also has majorly botched their reverse split announcement, but we'll get to that, and I'll do a live stream, and I'll prepare everybody on how the options are going to look and what's going to happen. In fact, I will probably, the next live stream that I do, because I might be anticipating a whole bunch of VXX questions coming in today, the next live stream I do, we will dedicate the first 20 minutes to an actual VXX presentation. I will show what happened during the day before, the day of, how those option prices moved around. I'll kind of prepare people for what it looks like on the front end, at least for my softwares. I can't speak on ones I've never used, but Thinkorswim, Interactive Brokers. yeah, I can help you out. So if that happened to you and it mattered to you, then yeah, I'm definitely sorry that that happened. Most people should prepare ahead of time what they're going to do with their options in the event of a reverse split. And when it happens, the things that you mentioned can be an issue. The longer you hold it past the reverse split, liquidity can start to become a problem. Bid-ask spreads can widen. Those market makers are no longer manage them quite as well as they did before. These are all things that can happen. This last part, that's where I think I have to give you the unfortunate answer that no, there's no avenue here for any type of suing them or trying to get any lost money back. From their end, I'm not a lawyer, don't quote me on this, but from their end, I think they did more than enough to at least remove any, it's not negligent on their part. They announced it a week and a half ahead of time, and this is the 6th reverse split. People kind of know how it works. Unfortunately, no. And I hate to say that, I really do. I don't want to tell somebody that it sounds like you lost money. I don't want to tell somebody who lost money that no, you have no recourse. But unfortunately, no. I think that what happened was basically on the up and up. I'm not trying to insult you. I'm sorry if it sounds a little bit cold and direct, but I think it was well telegraphed ahead of time, and I don't think there's anything that can be done. I just think it's a live and learn, live to fight another day, and do better next time. UVXY will be splitting soon. If you have options on that, make a plan ahead of time, and I'll help you. I'll do a stream on UVXY right before it happens as well. So follow me, and we'll get you through the next one. Sorry that happened to you. Okay, Hans, using stock replacement for tactical volatility, I'd like to see information comparing profit loss first and second consecutive rolls against opening position for position sizing help. All right, there's several things in this. First of all, I could maybe split up that data in some way. I think what you're asking is, for example, recently in our tactical volatility strategy, the position that we have open currently is we are long the September VXX 14 put. We actually have to rebalance this strategy because stock replacement is a very good method of shorting volatility. It's, in my opinion, it's probably the best, the most efficient, and the safest. So stock replacement's awesome in that respect, but it does have one downside in that it is a theta negative trade. So we do have to try to keep that theta further off in the distance, which is why my contracts typically are well over 100 days to expiry. And if we hold the position open for a significant amount of time, like we've been short vol for a while now. I mean, the VXX has been just really cooperating nicely. So we actually had to do a couple of rebalances along the way. I believe what you're asking is, you would like me to show some data based on the performance of the original positions versus how the second positions have done when we needed those follow-ups. I assume that that's what you're asking. I'll think of a way, and I can show you the data, but the problem is that the second positions, they're not open nearly as long. And while I don't think that volatility is in the short term mean reverting, it certainly is in the medium term mean reverting, mean median mode reverting. So those second positions probably have less likelihood of being able to chase for a while, because at some point the market takes a break, right? It's not. Sorry, you're looking at screen share still. Sorry, I do that sometimes. At some point, this VXX is going to have to take a breather. At some point, the S&P 500 is at least, there's two types of corrections. You can either have a price correction where it actually goes down, or you can just have a time correction where it just chops around for a while. At some point, one of those two things is going to happen, and the follow-up positions in our tactical vol, they don't have as high a likelihood of succeeding. But that in itself isn't a reason not to hold them. We don't exit positions until we have a quantifiable reason to do so. So I can tell you ahead of time, the numbers will come back showing that the first position is stronger than the second. I just know that to be true. But there's no way to use that actionably to manage risk. We still take those second positions. We still rebalance. And the position we're in right now, it's also doing really well because the VXX cooperates. At some point, the VXX will reverse. It will kick us out into the cash, and maybe we'll lose a little bit on that upside. There's always a little bit of give back when you're a short vol investor. Everybody knows about the give back that I'm talking about. So yeah, that'll happen at some point. As far as sizing, the third part of this question, I size 20% always. It doesn't change. And I choose the delta factor based on the strength of the signals. So right now we're at a delta, at least in the day we initiated, the delta was 0.49. That's just 0.49 delta compared to the VXX based on the strength of the signals at the time. That's the sizing. If you want to go rogue and deviate from that, then that would be deviating from my daily signals. And, that would be, I'm not going to say risky, but that would be an interesting choice considering you don't really know the underlying metrics that I'm making decisions on. So deviating from what I say, given I have full 100% info and you may only have partial info, that would be difficult to size your own trade like that. Hopefully I answered that question. It's a difficult thing because I can tell you already the second trades are weaker than the first, but I still take them every time. You still have to follow the signals. So there's a couple chat ones here. If I miss anybody's question, sometimes my chat doesn't show everything. So just tune into the next live stream and ask it again. Apologies, I don't intend to miss any. Which way is better to realize leveraged tactical portfolio? Leveraged ETFs or doubling the non-leveraged? Based on how we trade, tactical, rotating in and out, it doesn't really matter that much. What you're getting at is that there is some beta slippage with leveraged ETFs versus just doubling up your position. So if you're in a margin account and you're worried about that beta slippage, remember it does go both ways. You can always just take 2 times the amount. If you're in a margin account, there's always going to be available margin for you to just double up. So instead of the SSO, you could just do 2 times the SPY. As far as the actual results, I could take a picture of this and I'll answer that question exactly with the numbers for you if you want. I can just very easily compile that. So maybe in a follow-up live stream, I'll just show you the results. Instead of speaking on it, why don't I just put this one on hold for a second and get you the exact answer? But overall, because we're not in positions for 6 months in a row, we do tactically rotate in and out. It's not going to matter a whole lot. There may be a few % difference either way, but I will get you the exact number. That's a good question. When I feel like I'm underexposed to tech, I buy a few shares of FNGU. But it's a crapshoot on profitability. FNGU, you say. Bank of Montreal Microsectors FANG Index, 3 times leveraged, it appears. Okay, you can do that. I don't. Again, my streams are never direct personalized recommendations. I do have all my portfolio management certifications and all that stuff, but everything has to be in jurisdictions as well. So I am definitely not a registered advisor in very likely any of your, I'm not a registered advisor at all right now in Canada either. So I can never give out personalized investment advice. I can just say, I would do that personally. I wouldn't do that personally. I feel it's a little bit risky. So when I look at this question, I think, why that one? Why not just the QLD? If you feel like you're underexposed to tech, there's no reason to go crazy on it. I mean, a 3 times leveraged FANG, that's a little bit leveraged, right? That's pretty extreme, and you're opening yourself up to pretty large drawdowns if you catch that timing wrong. I don't ever go more than 2 times leveraged in any of my strategies. Can't tell you not to, but that seems to be a pretty good balance between trying to get that extra kick of explosive growth while still being able to maintain a reasonable mental state if you happen to get the timing wrong. Because we try to exit positions before drawdowns, but everybody gets caught from time to time. You are going to get hit with something unexpected, and to be 3 times leveraged, it's going to hurt. So not that 2 times doesn't either, but at least it's 2, not 3. I personally don't ever go for more than 2 times, just to comment on that one. Oh, compliments here. Thank you. I really do appreciate compliments. I'm poor at taking them, but thank you. I'll keep doing this as long as people keep watching. I'll make the videos if you keep watching them. So thank you for that. And if people want to know how they can support me, I mean, I don't, everything's basically free. You can follow along. There's about 1,000 articles and videos. It's all free for you. Just share my work. That would be helpful. If you're ever on Twitter and you see something I said, just retweet it to your community, stuff like that. Give the video a like for me. Simple stuff like that. But thank you very much. That's very nice of you. I will keep going. I've got a massive list of hundreds of topics to get to, so we're just starting here. How much attention do you pay to the volatility skew? If it is relevant for you, could you share a little about how you incorporate that information in your strategies? 0 for our tactical strategies. It's not a meaningful input for me. For option trading, that's when you can get into, for an option trade, you want, of course, they're usually discretionary. So you pick the good trades, and then when you're trying to fine tune that trade to make the right expirations, the right strikes, things like that, you could start to take these things into account. So just as a rough example, one of our volatility metrics is the VIX minus volley. So these are our volatility metrics, our volatility dashboard. We've got the main one, the volatility barometer is the big one, of course. But we've also got a few smaller ones. So this is sort of getting into the, that aspect of where you're trying to fine tune your trades. We've got the VIX minus volley residual. So what does this mean? Well, the VIX index is a measure of S&P 500 options activity, but it uses a basket of all strikes. Maybe not all, but a massive range of strikes. Whereas the volley, and that's on the SPX options, the volley is basically a volatility index quite similar to the VIX in that it is S&P 500 options activity, but they use the SPY and they use only at the money strikes. So when you subtract the VIX, which is all the strikes, and the volley, which is just at the money strikes, you're essentially targeting out of the money activity. How large is that? So if you get a massive discrepancy, for example, and you see that the VIX minus volley residual is very high, that's when you get into the fine tuning of option selection, where you could choose the difference between a straddle, say a short straddle, which is selling, looks like this, selling at the money premium. Well, you would want to do that basically if the at the money premium is statistically higher than the out of the money premium. You're talking about skews and volatility differences. Iron condors are wide. So if you see that, well, we're in a certain period where out of the money options are actually paying much more than those at the monies, well, then you could select the iron condor. A short straddle and a short iron condor are very similar trades, but it gets into the fine tuning aspect. So to answer your question, I would look at things like that as a sort of a secondary follow-up. Once I've determined what I'm actually going to be doing, at that point, you do want to look for efficiency and you want to find ways to get yourself into the best positions possible, save a few pennies here and there, sell a strike that's slightly better than the other strike. It all adds up long term. So that's how I would maybe get into looking at things like that. But for my 4 tactical strategies, it's not a consideration. I don't expect COVID returns, but I would love for this to perform on par with QLD. Well, like I showed, for the first 5.5 years, it essentially did. So that somewhat begs the question, why not just hold the underlying? If you're holding something with the expectation of, boy, I would love if I could get the NASDAQ returns, why pay extra for the management fees of the ARKK Innovation ETF when you can just hold the NASDAQ? If you're trying to get better than the NASDAQ, that's when you have to go outside of the NASDAQ and look for better options for you. But if that's your goal, you've already got it. You've got the market. You've got the index. Now, I'm not a buy and hold investor. I'm not saying that, hey, that's a great idea, you just buy and hold. It will suffer insane drawdowns along the way. You have to make sure that you have the personal risk tolerance to sustain that. I don't. I can't see my portfolio draw down that much. For me personally, I start to get nervous at 10 or 15%. I mean, our portfolios, they just don't draw down, or at least I should say they have not. The largest drawdown we've ever had at VTS is in 2012, we had a 7.7%. And since then, nothing over 5.6. There was a 5.6, there was a 5, a 4.6, but mid to low single digit drawdowns. For me personally, everybody has to make their own decisions. I mean, I don't like when my portfolio draws down more than 10%. I just don't. So I have to trade to make sure that that has a low probability of happening. Of course, anything could happen. We could wake up Monday and October 87 happens and I get my largest drawdown in a single day because there was no warning. That could happen for sure. But if you want the NASDAQ, it's got a low management fee. It's sitting right there for you, and it's the market. So you're going to have all of those companies weighted to their size. If you want to do better, if you really think, NASDAQ's not enough, I need to supercharge. Well, you've got the 2 times NASDAQ, right? It's more predictable. I cannot say whether the 2 times NASDAQ will outperform the ARK. I can't make that statement. But I think in 6.5 years, the statement I can make is that it will do it more consistently and more predictably, and with a better correlation factor to other things that you are probably holding in your portfolio as well. It's much easier to know your correlation between the NASDAQ to your real estate ETFs than it is the ARK to your real estate ETFs or to your gold holdings or how bonds work into the equation. The NASDAQ's just a better input variable in that respect because we have a much more consistent body of, we've got longer term data and way more consistency from different period to different period. ARK is just a rock star in the last 1 year. Average to below average the 5.5 years before that. So how do you weigh that for yourself? I would ask, starting today going forward. It's not. It's public. I do both. We do a lot more private live streams that's only for our VTS community, but I do sometimes. I'd like to get into the habit maybe once a week of doing a public one for everybody on Twitter and Facebook and LinkedIn. Having a place where you can ask questions. I'm not saying I'm going to, give you the best answers in the world, but there's a lot of traders out there that are kind of just bumping around in the dark, and they do need a little bit of guidance. A lot of you, not you maybe watching, but a lot of my Twitter following didn't even know the VXX was reverse splitting. So I do want to make myself available publicly as well and give you guys just help as much as I can. If I've got an hour or two, I don't mind doing this. But Hans, you're a member. Of course, I'll prioritize the private live streams in front of the public ones. We can talk about more interesting things in the private community because it's our actual money. Our portfolios are on the line, so it's much more serious stuff. Public live streams will be me choosing a subject, ARK, or my next stream, VXX reverse split, and then just open Q&A. So we'll just see what rolls in. Russ, no, sorry, I shouldn't have clicked. Caught my eye and actually poor at this. On my end, the comment section's actually hard to keep up with. I know sometimes people are like, that's not the next question, but my software is a little bit weird. It skips massive amounts sometimes. So, and then my fat fingers click the question before actually realizing that's not the next question. This is interesting. So this is Alan saying that they've been trading the wheel strategy on ARK and now ARKF. For anybody wondering, the wheel strategy, in my VTS options community, we call it the Wheel of Fun. And the reason it's called the Wheel of Fun is because you essentially start with selling a naked put option on an underlying ETF or stock or whatever. It's typically something that's been beaten down and it has a little bit higher premium there. And if you get assigned, well, then you turn around and you sell covered calls aggressively to try to get rid of that position. If you don't get assigned, you just keep your premium and you look for a new target. So it kind of goes around in a circle. For me personally, it's my Wheel of Fun strategy. So doing the Wheel of Fun on the ARK, let me just check for 1 second here if anything stands out in my head. is that? I'm going to look at a 3-year. Because again, the problem with the ARK fund, if there is one major underlying theme that I keep getting back to, is just the wild inconsistencies from period to period. And that, as a trader, at least as somebody who uses input variables for their trading, I'm not just using my gut instincts. Every single trade I ever put on is quantifiable. I can determine the probability and the historical data. There's just so much inconsistency with ARK from period to period. How it was doing in 5 years ago, 3, 2, 1, it's an entirely different animal over the 5-6 year period. So I can see here, yeah, I mean, you're going to get good premiums. Let's check the volume. I've never even traded an ARK option before. Is it an active? It's not a overly active options market compared to the NASDAQ. Of course, the NASDAQ crushes it in volume. I don't know. I don't see much purpose for it. And I didn't want to do this stream saying that it's just bad and people wouldn't do it, but it just doesn't fit in with my style of trading. It's just, it is what it is. They've done tremendously well, but I would just use the wheel strategy with the NASDAQ, with what we can more predictably match with the rest of our portfolio. Because remember, the wheel of fun strategy, it's not just, you just don't do it on a whim. A lot of people think when you sell naked puts, well, I wanted to own that thing anyway, so it doesn't matter. It's like free money. You can just get free money. It's not quite that way. There is definitely risk there. You are subject to nearly all of the downside when you're selling a naked put. Yes, you collected a little upfront premium, but you are subject to most minus that premium of the downside, right? The risk reward profile is not nearly as attractive as people think it is. And there's a lot of people out there, a lot of dangerous, online trading gurus who will tell you that this is some type of brilliant income strategy where you can just slap these things on anytime you want. It's totally not the case. It's the same with covered calls. You've not reduced your risk at all. Minus the premium that you collect. It's not some holy grail thing. So be very careful with the underlines you choose. And if you're in the VTS community, one of my rules is that I don't apply the wheel strategy to things that can crash insane amounts. The only time I would ever do it, we typically do things like normal stocks, normal ETFs. The only time I do it on VXX, of course, but that's because the rest of my portfolio, 80% of my money has the opposite trade on. So the risk is totally different with the vol trend strategy. But personally, I would not select targets for a wheel strategy that can crash that fast and decouple that much from the underlying index. It's risky. You can find yourself down quite a bit and then wondering, what do I do? I like to choose high premium, yes, higher volatility, good, but not. I'm trying to navigate this without telling you no, because I can't give out any personalized advice. But for me personally, I would not use the wheel strategy on ARK. Let's leave it at that. Okay, this is funny. Watch my videos at 1.5 speed. All right, well, if you want to hear volatility, taught to you by a chipmunk, then you could do that. I'm sure it sounds pretty funny. Any liquidity concerns with ARK? Russell Rhodes, thanks for stopping by. With large outflows of funds. Yeah, I would say yeah. The thing is, though, I think for me, this is where I try to avoid getting into the conspiracy side of things, because you've got several things working together to get the ARK fund to 22 billion. And it's, chicken and egg kind of aspect where it's largely due to companies like Tesla. But is Tesla largely shooting upward because of this, right? These things only catch media attention when they're going up, but they only really go up explosively when they catch media attention. So you never really know what is going on behind the scenes and how much of this capital is well thought out, experienced people making rational decisions. So I think there's always risk of that. I mean, if based on my presentation today, did any of you, and there's roughly 100 people were watching when I was doing the presentation, was anybody super bullish on the ARKK Innovation ETF before I started? Probably yes, because the news is just raving about this thing. Probably yes. When I presented the data and I showed you how inconsistent it is and how the correlations break down from period to period and how the NASDAQ and the 2 times NASDAQ on a risk-adjusted basis are just as good, if not better, for much cheaper fees. At the end of it, I'm sure there's a few of you going, oh, wow, I didn't know there were better alternatives. So what happens if a lot of people start realizing that this thing is a Tesla monster plus a few others? I don't know. I don't know. I think it could get ugly. I don't think it will, because once the media catches on these momentum stuff, sky's the limit. But I don't see it. I mean, I can't put my money in it, so am I wrong? Are the 22 billion under management, are they right and I'm wrong? I don't think so. I just don't think they have any, just don't think maybe not all of them did their homework. I think there's better choices out there. So I don't know why it has 22 billion under management. What does the QLD have? Like a fifth of that? I haven't checked in ages. QLD has 4 billion. Yeah, I mean, we're talking about the ARK fund has 6 times assets under management than the QLD, and it's worse. In every quantifiable way, it's worse. Go figure. Have you seen any updates on the new ETF approval that could potentially replace the old XIV? No ETF since I did my video, but just for people who are sort of waiting patiently for this thing to go, I've done a video. Well, I've done 2. It's actually been quite a while. So if you type in SVIX on my YouTube channel, there's a little search function here. You'll get 2 videos. The first one that I did, the one that's called A New SVIX, this is actually over a year ago. So they filed for the new XIV replacement well over a year ago now, like a year and 4 months. But then I did do a follow-up. Why isn't it showing up? Type XIV instead. There we go. This one's much newer. This is only 3 weeks ago. And I went into the fact that it has now gone to the second stage where it has been approved. So it filed over a year ago. It's been approved recently, a month ago. And now we could wake up one morning and just have the thing active. There could be several delays. Watch that video. I went over, it's not a sure thing. It's not a slam dunk or anything, but yeah, we could just wake up one morning and there it is, the new XIV. And I will probably watch it for a while. I want to understand its methodology. I think it's going to be better. I think it's going to widen the rebalancing period before the market closes. And I think they can do a little bit of clever tricks there, just tweak it a little bit and make it much safer. And so I may use it, but I probably won't use it, day one or anything, but I'll find a place for it. So I'm also patiently waiting for that thing to go. But yeah, there it is. It's filed, approved. Let's just see when it goes. Let's just see when it becomes active. Could be any day, could be never. I don't know. Defensive rotation, much superior than ARK. Yes, it is, of course, because we manage drawdowns. Right? This is the entire concept of my whole portfolio is, yeah, it's great if you can have those slam dunk wins and you can chase momentum and you can make a bunch of profit. That's great. But the true success comes from managing drawdowns. The reason my portfolio has made in live trading since I started my business 20% a year since 2012, that's the unleveraged portfolio. Just standard no leverage 20% a year. It's not because we make a whole bunch of money when the market is good. We do okay. We underperform the S&P, but we try to keep pace, right? But the reason that I've done so well over 9 years is managing drawdowns, right? That's everything. So the ARK fund, as I showed you, had a drawdown, several of them, but one of them being 44%. And let's just see, I guess eyeballing it, right? I didn't go top 5 drawdowns, but several of these are 20, 30, 40, very, very regular drawdowns. And as we know, mathematically speaking, drawdowns are much more punishing than gains help you. So the standard example, start with 10 grand, make 50%, you're at 15,000, lose 50%. A lot of people say, well, I made 50 in 2020, I lost 50 in 2021, must be back to break even. Well, no, the 15,000 goes to 7,500 and you're lost 25% of your money. Even though you're up 50, down 50, that's an arithmetic average. Compounded geometrically, which is what investment returns are, you're down 25%. So yes, of course, the defensive rotation is much superior to ARK, but I've never had a period where it made 191% in 1 year, and never will. I can confidently say that's never going to happen. But if I can keep my drawdowns to 10, 15, maybe 20% in an extreme case, I'm definitely going to crush that fund. Absolutely. That's what tactical investing is. It's finding ways to not suffer insane drawdowns, right? I mean, I lost nothing, 0% in the COVID crash, whereas the broad market was down 34. It had to recover 50% after the crash just to get back to break even. We didn't have to do that. We just start on day one. We can just get back into the market and start trading again. So yeah, manage drawdowns. Don't chase success. Don't chase big profit. I guess that's sort of a little side message of today's presentation is don't be fooled by this, the 33.5. Focus on this. How's your brain going to react when you see your money down 43%? You're probably going to pull the plug right here, and half of this recovery doesn't even apply to you anymore. So that tends to be what happens to long-term investing, is that people get far too focused on big gains, big profit, big leverage, let's just make money. And they forget the easiest way to make a lot of money is to not lose money. Seems obvious, but very few people in the investment world focus on that for some reason. So yeah, control your drawdowns, everyone. And your long-term results will thank you for it. So the ARK fund management would argue that the indexes hold a lot of old companies on downtrends that will dog its performance in the next 10 to 20 years. Would that be a concern to you? No, because the indexes are indexes for a reason. There will be plenty of dogs in the index, but overall, you don't care about that. You just care about the overall performance, the comprehensive performance. And I'm sure that they would argue that. And what they would also probably tell you, and I'm not here to tell you they're wrong, it's a very common thing that people say, is that they have the ability to stock pick and weed those ones out. So not only are they telling you that they don't want to invest in all the dogs that are in the index, but they'll also tell you that they know which ones are the dogs and which ones are the good ones. What do we know about active asset managers, even if they are a 30-year experienced veteran who's written 7 books and has a PhD from Harvard? 85% of them can't beat the index. So you hear this a lot that, well, I don't want to hold all the bad ones. I just want to pick all the good ones. Sounds great in theory, and it certainly worked in the last 1 year, but they were also trying to do that from 2014 to 2020, and it didn't work. So I don't invest that way. I don't invest based on my gut predictions. I invest based on quantifiable data, and it's just, I try to stay away from stock picking because we've seen there are a lot of people, when we say things like that, well, 85% of active managers underperform their benchmarks. The gut reaction is, well, they're idiots, right? Everybody on Wall Street, they're all dumb. They don't know how to make money. They're not dumb at all. These really are the smartest, most experienced people in the investment world. It's just they're trying to do something that can't be done. Right? They're handcuffed for several regulatory reasons, compliance reasons, and just the fact that some years you nail it and your gut instinct tells you perfectly, and you bought Tesla right at the bottom. And then some years you bought Tesla and it dropped 80% on you or whatever it is. Amazon dropped 91% or whatever it is. We're all subject to this. We can nail it sometimes and we can get it completely wrong in other times. When the index gets something completely wrong, the result is predictable to how that will look in your portfolio. When an actively managed discretionary fund gets it completely wrong, which they will, at some point, everything they choose will be wrong. Just like in the last year, everything they chose was right, made 191%. At some point, everything they select in their fund will be wrong, or maybe not everything, but you get my point. When that happens, it's very unpredictable how that will interact with the rest of your portfolio. So I know that they would argue that, and they will tell you that they have the solution, that they have the hot hand, and they're going to be the ones that just, I know that one's bad, but this one's good. Great. I don't want any part of that personally. I'm not betting my money on someone else's stock picking. If there's going to be stock picking done, it's going to be by me, and it won't be done because that's not my style. So indexes are always, it's not just that they are representative of all the companies, but it's like I've been saying, they are predictable in their correlations to other assets. That's a highly overlooked aspect of an index. Discretionary funds, you can't possibly know how it's going to interact, and that in itself disqualifies it from my portfolio. Here's a funny one. Who are you? How did you find me? I mean, the only reason you would have seen the stream would be that you already knew me. So, welcome. Thank you for joining. I'm just some guy. You're gonna have to do some background work and read some of my stuff. Otherwise, assume I'm one of the 85% of managers who don't know what they're doing. Assume I'm one of the 99% of trading scam artists out there that are just lying to you. Make that assumption from the get-go, and then give my work a look, and maybe I can convince you otherwise. So thanks for joining us, and hopefully you come back next time. So we're getting at an hour. I'm going to wrap it up pretty quick here. Can I ask how many months do you have to live in your tax country? I think you mentioned is Dubai. Well, I'm in Vancouver right now. This question's being asked because I'm basically a digital nomad. I move around. I like to travel. Goes back to my professional golf days where I lived out of a suitcase for 5 years and just traveled around different continents, different countries, playing golf. And many people in the pro golf world didn't like that aspect, but for me, it was a perk of the job. I really liked it. So after I retired from golf, 2005, I started investing. I still like that feeling. So sometimes you'll tune in and I'll be in Dubai, or sometimes you'll tune in and maybe I'm in Europe or something. How long do you have? It's different in every country. The thing I always recommend about being a digital nomad, being somebody who doesn't have a permanent residence, is really do it legally. I mean, there are so many people that try to do it. They make these assumptions, these broad assumptions about tax law and this many days in this country, and I don't have to pay taxes to that country, because they make all these assumptions. Make sure you're doing things legally, because it's different in every country. They all have different laws. I believe right now, don't quote me on this, but I believe Dubai has a special program they initiated just after COVID where digital nomads can now get a 1-year resident visa, basically just proving that you're a nomad and you have a little bit of money in the bank account. So Dubai, I know that a lot of the Caribbean countries did this as well. So it's typically 90 days and under normal circumstances, but I do believe Dubai has extended it to a full year where they're encouraging digital nomads to live in Dubai. So there you go. Keep that answer short because it's going to be different for everybody. I mean, I'm Canadian, so my tax situation would be different. If you're an American, really make sure you do this legally, because you can't avoid taxes if you're American. There's only 2 countries in the world that tax their citizens no matter where you are in the world. And the United States is one of them. So you're not equivalent to me as a Canadian. I can't give you advice. It's just my business, my country of residence, my situation. During the past week, interesting. I don't look at performance week to week. Up. I don't know how much. Today I've only been talking about the defensive rotation, but I think that strategy's up like 7%. The non-leveraged one, 7% in the last couple of weeks. Something like that. Leveraged one, maybe 13% in the last couple of weeks. I don't look short-term results. I don't even look month to month. I have to report it, right? For anybody who's curious, I do report all performance based on closing prices of all the trades that we do. I've been doing this for over 9 years. You can always just go to the website and see the up-to-date performance. But I don't look at the month to month at all. It really has no effect on what I'm doing. My portfolio is long-term. I'm trying to get myself to my finish line 20 years from now. So what happens month to month really doesn't matter. I'm trying to manage drawdowns and trying to keep pushing forward, right? Obviously do much better than buy and hold, but I don't know the last 2 weeks. And I suggest you don't care either. I'd suggest you don't care about month to month either. It's not helpful for your investing to be scrutinizing on such short windows. 4, 6 months starts to become fairly meaningful, but obviously this is a long-term process, and you don't want to get trapped in the minutia of, oh, how did I do this week? Well, what's my account look like tomorrow? It just is totally irrelevant. Make good decisions. This is what I always tell people. Do more of what works, less of what doesn't. Make good decisions and just rinse, repeat. Right? If you just do that, do more of what works well, make good decisions, long term, 20 years from now, it's going to look fantastic. You're going to have some bad weeks here and there. You're going to have some bad months or bad 6-month stretches here and there. But don't allow your brain to be hyper-focused on short-term results. That's a very bad thing. You know, my standard token golf analogy. I can't tell you how many days or weeks I've had where I felt like a complete rookie on the golf course. But that's not important. You really don't want to focus on results. You want to focus on process. Always process, never results. And so looking at results, I have to do it. I have to report it. It's just part of my business to show everybody what the portfolio is doing, you know. But if I could, ideally, I'd show year to year. I think that would be better. It wouldn't cloud people's, it wouldn't influence people's decision. So I appreciate the question, but don't look at weeks. To answer it, though, we've done well the last week. This is interesting. This will be the last one. And then I'll just do another live stream maybe Monday or Tuesday. So follow me on Twitter. Where are we at here? Follow my Twitter handle, and you'll always get notified of all upcoming live streams. So where was that question? Have you ever considered incorporating broad-based international equity ETFs like EFA or EEM into your trading strategies? No. I do not see the point. They significantly underperform, so that would be one reason not to. But, you know, some people make the case, and for some reason, a lot of people bring up, there's another investor out there, some of you probably know, Christopher Cole, who a lot of people try to draw comparisons between us. There's not many similarities, to be honest. He's more buy and hold. I'm a tactical investor. But a lot of people like that make the case for international, for commodities, for all these things. And while I may say that's fine and that's good if you're a buy and hold investor, maybe you'd want to worry about what's going to happen 5 years from now. The way that I invest tactically is day to day. I don't have to know that, okay, international stocks might have a nice recovery and start to outperform over the next 5 years. I don't have to know that. I just have to know what's most likely to happen tomorrow. And then I'll get my metrics tomorrow, I'll input all the data, I'll make my trade decisions for one day, and then I'll do it the next day. And that doesn't mean that we're not day traders. If the signals are the same for a month in a row, then I just maintain the same position a month in a row. But I check the metrics every single day, and I'm willing to exit any position on a one-day time frame. So right now, and certainly for a very long period of time, the EEM and these international funds have not shown me anything I'm interested in. When they change, I can change as well. So I'm not saying I never would, but they have to actually be showing me results. Not the results should come 2-3 years from now because the dollar does this and the Fed does that and all those macroeconomic reasons. I don't trade macroeconomics. I'm hyper-focused on single-day metrics. And those are not advantageous for any of our strategies right now. I'll leave the door open in the future, but right now, absolutely no. The U.S. markets are where it's at, for sure. So thanks everybody for coming. Again, give the video a like on your way out the door. That's very, very helpful for me. So thank you for that. And again, follow me on Twitter. My next stream will very likely be VXX, UVXY, split related with the somewhat nightmare in the options market that we were talking about the very first question today. No, there's no potential for a class action lawsuit, but I will fully grant you that the rollout of these reverse splits was botched, and we'll talk about that and check out what those option strings look like. So thanks, everybody. Have a great day. Have a great weekend, and I will see you probably Monday or Tuesday. So thanks for coming.